Good evening, everyone. Once again, a warm welcome to this session. I'm Rashmi from Grade HR and today's moderator of this session. So first of all, I would like to welcome all of you today to our 31st Ask the Expert webinar Parichay session. And as you all know, today is the most awaited topic and also very important topic is what I feel. And the topic is tax declaration and filing, a walkthrough for employees. Now, before I dive into the topic, let's do a little housekeeping on how the session goes. So the session is divided into two parts. The first part will be the presentation by our expert for today, which will then be followed by the audience Q&A. So dear attendees, I can say that audience Q&A, that's where the time is all yours. You can put across all your questions in the Zoom control panel, the Q&A option, and we would be more than happy to take it up and answer them. And also our expert will answer all of your questions today. Also, for any unforeseen circumstances, if you happen to miss out on any part of our today's session, not to worry at all, we have got you covered because currently the session is being recorded and the same will be shared with all of you soon. Now, without any further delay, let's start this session. So as you all know, the topic for today is tax declaration and filing, right? So income tax is one of the most significant sources of revenue for the government. This naturally means that taxpayers must be aware of each step that goes into paying their taxes on time. Right. So while most of us are aware of the significance of the income tax in our financial lives, it might be difficult at times to decipher complex jargons and legalese. A common question that leaves most stumped is the nuance between the terms income tax declaration and tax filing. So what are the forms to be used for the same? Why are these important? So in our today's session, in the next 1 hour, we are going to discuss all of this in length with our expert today, CA Agnel, and understand tax declaration and filing in detail. But before that, let me introduce our expert to all of you. So as you all can see, Mr. CA Agnel there on the screen. So to talk to you about Mr. Agnel's profile. Since 1990, when he passed his CA final exam with an All India rank, Mr. Agnel has built a professional track record in diverse fields, covering, among others, management consulting, audit and risk advisory for the banking sector with KPMG Bahrain, corporate, merchant and investment banking, MSME and new business setup and advisory, training and counseling, covering multiple industries, sectors, and geographies. Apart from his rich experience in the professional fields, he has also taken up many NPO responsibilities in professional, social, community, cultural, and sports organizations, major being the chairman, VC, and secretary roles at the Bahrain chapter of ICAI and technical director of Bahrain Cricket League. Since returning to India in 2012, Agnel now advises MSMEs and HNWIs for their various business and investment needs, including advising them on corporate commercial laws and tax matters. So Mr. Agnel also enjoys counseling and empowering the youth in taking calculated and reward-oriented risks in their careers, encouraging them to give wings to their creative ideas and guiding them on their career paths. So once again, Mr. Agnel, we are honored to have you here in this session. A warm welcome to you here.
Thank you, Rashmi. Well appreciated. And you have read all that I have written to you.
Okay. Yeah, it seemed to be very interesting. It's exciting, you know, like it's diversified. So
right. Yeah.
I don't want to miss out on any bit of it.
Thank you. Thank you very much. And it was a bit long. I think the audience may not like too much of introduction of the speaker rather than what he has to speak on the subject. So I don't want to delay them. Let me straight away start. Whenever you say yes, I will be ready to start.
So please go ahead. I would like to hand over the session to you.
Okay, thank you. Thank you very much. And just a note for audience, the photo that you are seeing is of many years ago. And I didn't want to hide my, hair or whatever, just to ensure that, I can show to you my experience of 30 years rather than color my hair and be younger by another 15 years. Okay, so
Wonderful.
I will also share my screen if you can just remove
Sure.
your sharing.
Definitely. Yeah.
Okay.
Over to
Yeah.
you.
Thank you. Okay. All right. Yeah. And just another note there is that I'm not an expert, to be very honest. I can be called as maybe a practitioner, a professional in this particular field. But expertise, I don't think it's quite easy to achieve. I will continue to be a student of all the subjects in this world. And let's keep the expert part later. And I'm here to learn as well, as much as all the audiences. I may share my experiences. I may share what I have learned and what I have practiced. But if there are a few things which our audience knows better, I'll be always be willing to learn and understand, as I do with even my children. Even my school-going kid who comes up with new ideas and new thoughts and new learnings all the time, and I keep learning. Okay, I think the screen has not yet started. 1 second. Okay. So the topic today is tax declarations and returns, tax returns filing, ITR filing. The topic that was asked initially was about tax declarations, but since I felt that tax declarations alone will not make much justice, I decided to add a bit more and also cover TDS responsibilities, tax deduction at source responsibilities of the employer, and also what are the uh, uh, takeaways for employers and employees in this whole gamut of tax filing. What we know for sure in this world, once we are born, are apparently two things. One is death and other is taxes. And as we know, we start paying taxes. And in fact, a baby yet to be born in his or her mother's womb still pays taxes, even though those taxes are paid by his or her representative assesses, that is her parents. Maybe the hospital bills where you pay the GST on that, the medicines or all the other accessories that you buy, you start paying taxes right from word go. And it goes on, and there are probably no items, barring maybe the air, fresh air, or some green views in this world. Everything is taxable. But today's topic is more specific to taxation of salaries, more specifically, and tax deduction related provisions, and the various forms that are needed to be filled up, submitted, and issued in this whole process. So I will start the session with this particular slide, where I have given a summary of what are the governing provisions of tax on salaries, and then the governing provision on the TDS aspect. Section 192 covers the tax deduction at source provisions relating to salaries. And there are income tax rules, various rules, basic being Rule 26A, and other various provisions of the Act. Okay, they're well spread out. Like Section 10 is also applicable, which covers a number of exemptions. Then there are deductions under Section 80, and and so on. Okay, so these are broad, in a broad way. I'm giving you some numbers, but I do not want to dwell with these numbers and rules and sections and forms much, except for the important needy ones, because most of these details are available on the web also. Anyone can find them easily, and most of the information is also available, but analysis thereof may be easy for somebody like me, maybe a professional, to explain to you in a reasonable detail. Now, the forms used by us in this tax deduction of at source, I'll say TDS, the word TDS, are, one is Form 12BB, which is submitted as a tax declaration or investment declaration or expenditure declaration, whichever word you can call, submitted by an employee to the employer. Then there's a Form 16, which is issued by the employer to employee. If there are perquisites and profits in lieu of salary paid, there is a Form 12BA also. And then there is Form 24Q, which is a quarterly TDS return filed by the employer with the income tax department. In summary, these are the key documents. Before I go into these forms, and before we even decide whether there is a salary and when there is a salary and not some other income, salary is where there is a relationship between an employer and employee. There has to be an employment happening between the employer and employee. Employee is providing his services as an employee to the employer. And then the tax deduction part of it, tax deduction happens during the whole year and not at any one single occasion during the year. Unlike a filing of tax and paying of self-assessment tax at a later stage. But TDS, tax deduction at source, has to happen throughout the year whenever there is a payment of salary or payment of any amount by the employer to the employee. Okay. And there are employees or taxpayers records with the IT department, which are resulting from the forms that are submitted, mainly from Form 24Q as it relates to salaries. And there are various other information that the tax department gets relating to your other incomes or other transactions, which are all captured in income tax records. And those are mainly, it used to be Form 26AS until about 2 years ago. And now we also have what is known as an annual information statement and taxpayers information statement. All of these are available on an SSC's or an employee's or a taxpayer's page on the income tax portal, where you can access that with a PAN and a password. If you have been, your tax returns have been filed by other professional, if you take a password from them, you can also access your page on the income tax department. And there on the drop-down menus, you can see all this sort of information where even your tax return filing also happens on that particular page. So till here, I hope I am clear. I want to just repeat the governing provisions and the rules. Then the specific forms. Form 12BB, as I mentioned, is a tax declaration form issued by, submitted by an employee to the employer. I'll come to others as I go forward. Okay. As I said, it is a tax that is to be deducted on the salary income, but it is on an estimated basis using an average rate of tax. What I mean by this is, when a year starts, a financial year starts, in income tax parlance, that is also known as a previous year with respect to the assessment year. I'll give you the actual numbers. I know most of you are aware of, but in case someone doesn't even know, 1st April 2022 to 31st March 2023 is the financial year for which the assessment year starts on 1st April 2023. So assessment year is 1st April to 2023 to 2024 March 31st, for which the previous financial year is the previous year or financial year as referred in income tax. I know this is a bit complex. This has not undergone a change since the act was passed a long time ago. But well, let's not bother about that too much, because let us try to understand. Estimated income, because the employer estimates your income for the full year based on the salary level that exists and based on his experience of payment of other things. For example, if he is giving a bonus of 1 month salary, maybe during Diwali or maybe at a new year or maybe at the year end, he will also estimate that as your income as well. So he has to estimate at the beginning of the year, what is your total income for the year under the head salaries. I said under the head salaries because Normally, all other types of income that you are getting during the year have their own TDS rules. For example, if you get interest income from bank, if you get dividends from companies, if you have capital gains, if you have business income, and such other income, there is a specific TDS requirement in each of those income streams. So here we focus only on salary and also a little bit on one other head of income for a specific reason, which I'll come to later. So estimated income at the beginning of the year based on the current salary level and based on a declaration by an employee as to what all deductions are eligible in his computation. What are deductions? For example, if the employer is giving you a house rent allowance, for that, there has to be a rent paid by you, which qualifies for deduction. Now, for that purpose, at the beginning of the year, it is sufficient for you to tell your employer or give a declaration saying that you are going to pay or you are currently paying a rent of so much, or you are going to pay rent of so much from this month onwards. And accordingly, please calculate my tax. For that, there is a specific computation methodology that can be discussed more on calculation of tax than under the formalities which we discuss over here about the tax declarations or ITR filing and so on. We are not going into details of tax computations, but to some extent, I will cover them a little later. And I said average rate of tax. Why average rate of tax? In salaries of, let's say, for individuals, we have slabs. Under the old tax regime, we have slab of up to 2.5 lakhs. There is no tax. 2.5 to 5 lakhs, there's 5%, and above 5 to 10, there is 20%, and above 10, there is 30% tax rate plus 4% education cess. And if your income exceeds 50 lakhs, there are surcharges which are applicable at various slabs. Now, based on these rates, he calculates your income tax liability for the full year, which is divided by 12. And that particular rate is applied on your monthly salary income by the employer. Okay, so after all the deductions are all made, and he has calculated your tax liability for the full year. For example, if your total salary income is, let's say, 10 lakhs, and your tax liability on that comes as 1 lakh, the tax rate, average tax rate is 10%. So 10% is applied on your monthly salary. This is at the beginning of the year, but this is not the end in itself. Whether you give it under Form 12BB or any other communication to the employer, at a later stage, the employer will require you to confirm whether you are actually investing the amounts that you stated to be invested at the beginning of the year. For example, if you say you have LIC of 1 lakh for this year, and you also tell him that you will invest in PPF for another 50,000, assuming that there are nothing else, no other, PF is not there, or being small and medium companies, it's possible that PF is not contributed by employer or employee. Now, if you said 50,000 you will be investing in PPF during the year, it is not necessary that you have to invest it in April or May itself. You can invest it in later as well, as long as before he pays you the last month's salary, that is March month's salary, if you have any modifications to make, you can do that to him, saying that, yes, I had decided to invest in PPF, but now because of my cash flow situation, I may not be investing in PPF. So please remove that PPF from the Section 80C deduction, and please recalculate my tax, and you may deduct the tax. Or you may say that instead of PPF, I have principal repayment on a housing loan. I have taken a housing loan during the year. Principal repayment on a housing loan, which is also qualifying under the Section 80C, investments or expenditure. So this is in a broad way, I am trying to tell you is that at the beginning, you give a declaration, and at the end of the year, before the end of the year, before he pays you the last month's salary, even though I said before he pays you the last month's salary, some of the employers are more proactive. They don't wait till March. They can ask you in December itself or in November, so that your tax liability in a particular month is not huge. Because what happens is, if it is all put into 1 month, your tax liability may eat into a lot of money in 1 month, and maybe you have invested or spent your salary of December, January, February, and in March you feel quite a tight situation with respect to your cash flow. So some of the employers, they try to even out a remaining deduction, if at all there is any balance tax deduction to be done. It also is possible that there may be extra money that is paid to you during the year. Maybe there is an arrear salary paid for the previous years. Maybe there is an extra bonus that they paid this year for whatever reason. There is some extra commission that they may have paid, which was not estimated at the beginning of the year. That also will be added to your salaries before the end of the year. So from the initial estimation to the final estimation, things may change during the year. And at the end of the year, he will also ask you to provide him the proof of payments. For example, I said rent for HRA. Now, up to rent amount of 1 lakh per annum, normally actual details are not sought, up to 1 lakh per annum. But more than that, you will have to give the name, address, and PAN number of the landlord to your employer. Okay, without that, employer can refuse to give you that allowance under the HRA. Okay. Now, since I mentioned about HRA, I'll just give you what is the amount eligible to be deducted for HRA. This is only one aspect I am trying to tell you about the computations. Others I will try to avoid because of the time. In HRA, your actual rent paid minus 10% of your basic plus DA and whatever specific allowances which qualify for your retirement benefits, those are deducted, and that net amount is considered as exempt. Okay, so that is rent minus 10%. That is one of the three amounts that are exempt. The second qualifying figure is actual HRA itself, and third qualifying figure is 40% for smaller towns and 50% in larger cities of your basic plus DA and so on. So one slab is 50%, one slab is rent minus 10%, and one option is actual HRA. Out of the three, whatever is the lowest is your exempt HRA. So to do that, he needs to know what rent you have paid, and all of this is summarized in what is known as Form 12BB. But later on, I will explain to you what is this Form 12BB. Is it a mandatory kind of form in the Income Tax Act or rules, or is it just a courtesy that is available for an employee? We'll come to that in the next slide. So that is one. Secondly, you may have joined this employment from another employer halfway, and it is possible because of your salary for the first 5-6 months was not big enough. The first employer may not have deducted tax on your salary. Here, under the Act and under the rules, it states that you are required to inform your current employer about the income that you have received from the previous employer, even though that part is not stated under Form 12BB. Okay, that is one. Secondly, there will also be a possibility that simultaneously at the same time, you may work for more than one employers, which is maybe permitted for whatever reason. Maybe it is different timing and so on. So in which case, employee has the option to choose which employer to inform about his total income from multiple employers. Employer 1, employer 2, if you are getting salary from both these employers, you can choose either employer 1 or employer 2, but give the details of total salary that you are getting from both the employers, or maybe more employers. Then there could be a third element where you may not be an employee for someone else. What we have been hearing of late in IT parlance is the concept called moonlighting. Many people are not happy about it, where employees of a particular employer also offer services on a fee basis to on a freelance basis for a fee. Now, for that, there are different provisions, because that fee that you earn is not as a employer-employee relationship. That comes under a different category altogether. It is income from profession. So, which we will discuss later, if at all it is an income from profession or income from business, or maybe just merely other sources. It may not qualify to be a salary because there may not be a employer-employee relationship over there. So those other employer details also need to be provided under the Act and rules, but they are not specifically shown in Form 12BB under the Income Tax Act. And an employer basically asks an employee whether he wants to be governed by the new tax regime, which I will give you a little bit of explanation on that in the later slide. From the current tax regime versus the new tax regime, where number of deductions are not allowed, but some slabs, the rate of taxation are lower. Okay, so till here, I hope I am clear about the tax computation by employer. Now, then there is a tax deduction and remittance. Now, as I mentioned, he is supposed to deduct tax on an average rate of tax basis on a monthly basis, and adjusted later on as the income increases or as the investments deductions increase or decrease. He is supposed to deduct tax and pay to the government by the 7th day of the following month. If not, you have certain interest and penalties. Okay, 7th of the following month, except for the month of March, where the due date for payment is 30th of April. Likewise, once that monthly payment of TDS is paid into the government, he has to file quarterly returns in Form 24Q by the 15th of the month following the quarter. 15th of the month following the quarter. But for the last quarter, the due date is 15th of May, not 15th of April. They are giving sufficient time for late payment of TDS on 30th April and giving you a quarterly, the filing of the quarterly return. Last couple of years, these kind of deadlines were slightly delayed because of the COVID reasons. And when the quarterly return is filed, your income tax records are updated in Form 26AS or in AIS or in TIS, Taxpayers Information Statements, in the Income Tax Department's records. And those are reflected. You can go there at any time if you have your user ID password, as I mentioned earlier, for the income tax side. From there, you can go to Form 26AS. And Form 26AS you can download for any of the past years as well. Okay. Now, once this is done, this is the routine monthly payment and quarterly filing of the returns. At the end of the year, after the end of the year, but within 2 months from the end of the year, the employer has to give Form 16 to the employee. And this is mandatory if tax has been deducted during the year. Suppose there has been no tax liability, no tax deduction done by the employer. It is not mandatory for the employer to give you, but you can always request for your records. You can always request. I will later on tell you what are the advantages of having a Form 16 in your hand, especially at the time of filing an ITR, even where your tax liability is zero. There are some advantages of doing that. Okay. So I mentioned about interest and penalties. So interest is 1% per month for non-deduction. Now, what is non-deduction? When you pay a salary to an employee, that is the moment at which you are supposed to deduct tax. Suppose you're not deducted and you deducted, let's say, in the next month. So you're delayed by a month, the deduction part itself. So 1% for non-deduction, for the period of non-deduction, you are required to pay on the amount you have not deducted, the TDS amount not deducted. And what you already deducted and not remitted, on that you have 1.5% per month for that TDS amount which you deducted but not remitted to the department. Say, for example, instead of 7th, you paid it on the 8th. I think it is a delay, and you will be required to pay the delayed interest for the full month, 1% per month. It is not part thereof. It is not 1% per month for a single day. It is for the full month. If your TDS was 1,000 rupees, 1% comes to 10 rupees, and entire 10 rupees has to be added as interest in the subsequent month's payment. If you have, or not subsequent month, in the same month's payment for the delayed payment. Okay. Then there is also a penalty of 200 rupees per day for delay in filing, but these are not normally invoked unless there is a very significant time lag. And let's say there are a number of employees who may have not found the credits in their Form 26As, because of which they are not able to file their returns. In those cases, employer may also have to pay a penalty, and this maximum penalty payable shall not exceed the TDS amount applicable for that particular month, which is delayed. There is also a penalty of 100 per day on the employer if he does not issue Form 16, if the employee complains only. Okay. Now, employee complains when they can't file a return, the Form 16 has not been received. And as I mentioned, Form 26AS may have the details. And today, the AIS and TIS will have little more details than just the amount of tax deduction. But yet, Part B of Form 16, which gives you the salary breakup, especially if you have number of different allowances and such breakdown, it is useful for you to have Form 16, because the Part B tells you more detail about your actual income, and Part A tells you about the taxes that are deducted. And there is also Form 12BA, which I mentioned earlier, where if the employer has given you any taxable perquisites, that also has to be stated in that Form 12BA, giving the details of perquisites included in the salary income. Okay, so far I hope it is fine. And let me go into the tax filing aspect. I know the time is not much. Let me cover about tax filing. Now, the point is, what is the obligation under the tax laws? For tax filing, it is basically employee. I mentioned about employer. He has to give you Form 16. Employee has to file a return. Now, the question may arise, is TDS done by employer or any other people paying you the income is sufficient, or is ITR filing necessary? The answer is very clear. TDS itself is not sufficient. ITR filing is necessary. And it is most of the times it is necessary by rule itself, because you may have tax liability due even after TDS. It is possible that tax liability may be due for other income that you may have received for which TDS has not been deducted. Okay, and similarly, you may choose. You may have given the employer one regime, and you may choose later on. Also, you have the option of choosing the new tax regime later on as well. And thirdly, there may be a refund you are eligible for. You can claim that refund. Okay. What are the advantages of tax filing? Tax filing helps you in a number of ways. Even if you have no tax liability, it is sometimes better to build a record with the IT department with filing of returns, which will be useful when you go for any loans with the banks. Banks will ask you for your ITRs for the last 2 or 3 years. So it is always useful for you to build your ITR record with the department. And even if you have no tax liability, if you have any foreign visit, for example, the visa rules also these days require your ITRs. ITRs are used as address proof documents. ITRs are required. Suppose you have some losses this year, you want to carry them forward, you need to file them within the due date, and so on. Okay, these are the general advantages of filing of tax returns, and TDS itself is not sufficient. And I'm aware of people who have not filed ITRs over the last 2-3 years, and those are not small tax payers. They are in slabs above 50 lakhs, above 1 crore also. And even those people, just because they were busy, they were traveling and so on, they did not entrust their task to some independent tax preparer. They have ignored, and now they have to catch up. You cannot file too many past years of tax returns in a year, maximum two more years you can file, and that also under a grievance option under the Income Tax Act. Now, the other question that will come for tax filing is which ITR forms to be used. This is another area where people make some mistakes. Generally, even if you have income below 50 lakhs for which ITR 1 is applicable, ITR 1 may not be applicable for other conditions. For example, you are a director or a partner. Maybe you are earning no income from these. You're a director or a partner in a company or a LLP. You will not be eligible for ITR 1. If you hold unlisted shares in any company, unlisted, as you know, let's say there is a startup, the new company, and you may be purely an employee over there, and the company has given you some shares in that company. Those are unlisted company shares. You cannot file ITR 1. And if you have any income or assets outside India, you cannot file ITR 1. So next ITR is ITR 2. ITR 2 is filed for people who have either income below 50 lakhs and all these conditions, as I mentioned, or income above 50 lakhs, whether or not these conditions apply, or if you are a not ordinarily resident in India or a non-resident. These are the conditions under which ITR 2 can be filed. You have various other incomes as well, but you should not have income from business or profession. That is where I mentioned the word moonlighting, which is you may have other source of income along with your salary income. You may have earned fees by advising different, customers, for example, maybe a number of startups. You may be advising them. You may be earning fees from them. That income will have to be stated under income from profession. So for that, you have either ITR 3 or ITR 4. ITR 3 is where you have business income as an individual, and ITR 4 is an easier return form where you can offer your income under presumptive tax basis. What I mean by presumptive tax basis, if you have income from business where your sales revenue is up to 2 crores, and or you have income from profession where your total income, total billings is less than 50 lakhs. In those cases where you are ready to offer a minimum of 50% of such income from profession, or minimum of 8% or 6%, I'll clarify this in a while, 8% or 6% on your sales billing, under the presumptive tax methodology, you can file ITR 4. What is this 8%, 6%? I'll just clarify. 8% of your sales turnover of 2 crore, if your cash receipts and or cash payments from that particular business is more than 5% of the total. I mean, I just repeat, if you have more than 5% of cash receipts or cash payments of your that particular business, you have to pay you have to declare 8% as your presumptive income under business. For professions, it is 50%, and 6% is applicable on business if your cash receipts or cash payments are less than 5% of the total. So that one part is business, one part is profession. I mentioned for business, it is 6% or 8% as the case may be. And in profession, it is 50%. Suppose your actual income from business is below 6% or 8%, and you want to actually show that much only. And likewise, under profession, let's say you have an office, maybe you have staff, you are paying rent and so on. After deducting various expenditure, your income is below that 50% presumptive tax. In those cases, you are required to undergo a tax audit and declare the actual income as audited by a practicing chartered accountant. So I hope that is clear. And if on an individual basis, in that case, you have to file ITR 3. There are other ITR forms, number 5 and 6 and 7. I won't even discuss. I'll just mention 5 is for firms and LLPs, 6 is for company, and 7 for some specific circumstances. Let's not delay on by discussing those. Up to now, I hope is clear. And yeah, this part I already mentioned. I'll just leave it for a minute for you to understand. ITR 1 is Sahaj or simple ITR form, where the details to be given are less. It is for individuals with salary plus 1 house property and income from other sources. And ITR 2 is for all other individuals except those who have business income, including those I said having foreign assets income, directorship, unlisted equity shares, and so on. ITR 3 is for business and profession, those who are not offering under presumptive tax under ITR 4. Okay. Now, old tax and new tax regime. I'll quickly give you idea of this. Even though the new tax regime shows lower tax rates for certain levels of income compared to the old tax rates. As I mentioned earlier, the old tax rates are up to 2,50,000 exempt. It is same in new tax regime as well. Between 2.5 to 5 lakhs, 5%, that is also same in both regimes. Now, thereafter, what happens? In old tax regime, there is a one single slab between 5 to 10 lakhs, which is broken into 2 parts under the new tax regime. 5 to 10 lakhs under the old regime is 20%, whereas here, as you see on the screen, 5 to 7.5 lakhs is 10%, 7.5 to 10 lakhs is 15%. Likewise, above 10 lakhs, in the old regime is 30%, but here, under the new regime, 10 to 12.5 is 20, 12.5 to 15 is 25. Above 15 lakhs, there is no difference between the old and new. However, lots of deductions, lots of exemptions that you otherwise get under the old tax regime are withdrawn. That's why people have realized that if you have all those allowances, let's say HRA where you pay rent, or Section 80 GG where you pay rent, you are eligible for that without having an HRA, or you have home loan interest up to 2 lakhs, which is deductible if you have one single self-occupied house property, and various deductions under Section 80C, 80CCD, 80D medical insurance, 80G donations, and so on, or even education loan under 80E. So all of these are not eligible to be deducted. So we have felt that you are continuing with the old tax rates is advisable. However, if you do not have any of these deductions, then you may, and if your income is in that particular bracket below 15 lakhs, so between say 10 to 15 lakhs, you may benefit. Okay, I will not go to specifically calculating these things because that is not part of our presentation today. Okay, before I go into this, if I may ask Rashmi, how much more time do I have? Is Rashmi there?
Yes, sir. Yes, sir.
Yeah.
Sir, you do have time. Please go ahead. It's 4:50. Yeah, you
okay,
can take 5 more minutes.
I can take just 5 minutes, and I will discuss a little bit more on the other income parts that sometimes get connected with our salary income. Okay. Yes. Now, one part I mentioned was moonlighting. Okay. Now, what happens is many times employees do not declare their income from other sources, fearing that they may have to pay a tax. Okay. That may not be a case if you have a reasonable level of income. I'll explain that to you in a while. And lastly, one more thing is that your tax liability for a year can be paid by way of advance tax also before 31st of March to avoid interest under Section 234. Now, what will happen if you do not give a declaration? Okay, is there a penalty? There is no penalty as such. The penalty is that your deductions, whatever you are eligible, your employer will not consider. That itself is your penalty. There is no penalty under Income Tax Act for not giving a declaration, tax declaration or investment declaration. Okay, but you still have the opportunity to pay an advance tax. And what happens even if you do not pay an advance tax? You have to pay interest under Section 234. 234A relates to late filing of returns, whereas 234B for not paying advance tax, and 234C for not paying TDS at the particular time slots that have been given to you. For individuals, salaried people, it is, you have September, December, and, March, all 15th of each of these months. And for others, business income and so on, you corporates and all, you have 15th of June as well. Okay. Now I'll quickly tell you how much of your income can still be without a tax liability, subject to meeting specific terms and conditions. How much of income you might still have, and you should not hesitate to file your returns in case you fall in that category. I will just stop sharing this one, and I will share a new new screen. One second. New file. I mean.
In the meantime, dear,
Yeah.
please, if you have any questions, please start putting them across in the Q&A option of Zoom panel. Yes, sir.
Okay.
To you.
Okay. Is the screen visible now?
Yes, sir, it is. Yeah.
Okay. I have just generally given a very rough calculations, and we'll take you through that. Okay. So here I've given you some rough estimated income level. Suppose you have a basic salary of 6 lakhs, and provided you are in one of the big cities, this calculation is, let's say your basic salary of 6 lakhs, HRA of 3 lakhs, total salary of 9 lakhs. Okay. And let's say you also have fee earned. Let's say you are a professional, maybe a CA, CS, lawyer, architect, interior designer, and such other professions which are specified. If you are freelance service provider also, let's say you have another 9 lakhs over there. So your gross income from this computation may come to about 18 lakhs. Now, we will calculate the exemptions and deductions next. HRA, I have considered you are paying 3,60,000 as rent for the year. So as per my mention earlier, your rent paid minus 10% of basic salary, which is 60,000, 3,60,000 minus 60,000, 3 lakhs, which is actually the HRA, which is deductible as an exemption, okay, or as a deduction. Then there is also a standard deduction, as you may already know, because most of you are either employers or employees. So you know about the standard deduction that you have. And I have mentioned to you this 50% presumptive tax adjustment, assuming that you are eligible under section 444 ADA and you are going to file a ITR 4. So 4.5 lakhs, which is 50% of the 9 lakh fee earned. Then you let's say you have done all the investments in LIC, NSC, PPF, or let's say you have a housing loan where your principal payments are all eligible under this. And suppose you also have some national pension scheme investment under 80 CCD of 50,000. I mentioned about interest on home loan on a self-occupied house up to 2 lakhs is deductible, where it is a self-occupied house only if you have a loan taken from one of the banks approved by RBI. Then let's say you have also taken education loan, which is about 1 lakh. So what happens is, on this 18 lakhs, you have all these deductions, if I show, are about 13 lakhs. Now 18 lakh minus 13 lakh, your total taxable income would be 5 lakhs. Here I wish to mention to you a concept called as rebate under section 87A. If your total or taxable income is not more than 5 lakhs, then the entire tax liability on that particular slab between 2.5 to 5 lakhs, which is 5% or 12,500, is eligible for rebate under section 87A. What it means is, on a 5 lakh income, you had a tax of 12,500 and entirely deducted as a rebate. So your net tax payable has become 0. So what it basically means is, even if you had a salary of, let's say, salary and HRA of say 9 lakhs, and then you earned some more fees, total receipts was 18 lakhs, and you have spent or invested 8,60,000. If you add up rent and your ATC and education loan and those amounts put together, you have actually spent 8,60,000 out of 18 lakhs, but yet you may not have a tax liability in a broadest sense subject to your eligibility under 44 ADA, you should be of one of those professions. And also, you may have other amounts you may be spending because of to earn this fee. Even I did not show that 50% deduction as the amount which is a known amount spent by you. It could be like that to earn that 9 lakhs, you may actually spend, you may travel, you may have other overheads and so on. That may be an amount which is not mentioned over here. And similarly, various other things that you may incur during the year. So this is one of the examples. And supposing you are not even an employed person, but you provide only the services as a professional, okay, professional or technical services. If we go by the presumptive tax basis, 10 lakhs is offered for tax. Out of this 10 lakhs, you have ATC, ATCCD, interest on home loan, education loan, and all of that. Let's say all of that put together is about 5 lakhs. Again, your tax is rebated under Section 87A. So even if you have income of 20 lakhs, under Section 44 ADA, you can offer it as a presumptive tax of 50%, presumptive income of 50%, on which tax is payable, and all these deductions that are made. So you have to file ITR 4 for that to be eligible under this. So this is in a nutshell. I have covered just an additional idea I have given to you that yes, government is waiting to tax you, but government also provides a number of scope. Government also provides scope for a number of ways in which you can plan your taxes. You are not evading taxes, you are not avoiding taxes, but you are planning your taxes in the right way. Suppose you were not aware of this and you did not disclose, but your income is still hitting your bank statement. And on one fine day, if there is an inquiry for whatever other reason, maybe you were found to have invested in a FD more than 10 lakhs and you did not file a return. Those informations are captured by Income Tax Department. There are various ways in which they gather details. So maybe cash deposits and so on. So it is better for you to offer, your income to tax, and also feel free to take the benefits and exemptions that are provided under the Income Tax Act. So this is in a nutshell I wanted to share with you. If I have not covered anything specific, please do let me know in your questions, and I will just go to the previous screen, and I will also give you one second. I'll also give you my contact details in case you are needing them at any time. If you have more questions, supposing I have not mentioned something, or if you have more details to be obtained or gathered, you are most welcome to contact me at any future time. I hope I have tried to fit it into the time available, Ms. Rashmi, and let me thank Great HR for having me here. And it was a learning process for me also, because Great HR is doing a number of useful things in this domain, in this HR domain, in the TDS and other matters. I noticed, and you as a very vibrant startup, you guys have done a lot of good work. I have noticed on your website. My congratulations and my best wishes to you guys as well, and my best wishes to all employers and employees who are on this presentation. And that's it. Over to you, Rashmi.
Thank you, sir. It's a pleasure to have you here, and thank you for your kind words. So I'm sure our audience have got a lot more information and detail on this buzzing topic. I must say it was an insightful and knowledgeable session. So sir, now we'll move to audience questions. I think our audience have already lined up their questions. Good to see them here. So one of our attendees have this question, that is how to do tax saving. What months are important regarding tax declaration and filing?
Okay. For a tax saving kind of a discussion, we may need a detailed advice on that. But broadly, I can tell you is that, suppose, let's say from my point of view, let's say you have taken a housing loan. I feel housing loan is one of the best ways for you to save on your taxes, and where it doesn't even require you to invest in maybe NSC, LIC, PPF, and so on. See, the limit under 80C is 1,50,000, and your interest payment for self-occupied house property is eligible for deduction up to 2 lakhs. That is, if you have one house. Okay. Now, this 2 lakh plus, let's say you pay a principal amount of repayment of a housing loan of 1,50,000. So the total amount here is 3.5 lakhs of EMIs. The total of EMI, total of 3.5 lakhs in a year, or 30,000 per month, is sufficient to be actually covering your 80C and as well as the interest paid for a self-occupied property, which is deductible up to an amount of 2 lakh. On top of that, there are other ways. Suppose you have taken an education loan, you should offer that. You get a deduction under Section 80E. You get also, an employer can also plan taxes in a suitable manner for their employees, especially instead of giving a lump sum salary. Because most of these times what happens is people move from their hometowns to the bigger cities and they have to take up a rented accommodation. Now, where an employer has taken a rented accommodation, and if an employer is giving them a lump sum salary, they may not even be able to claim that HRA. So employer can give them a breakdown of basic plus allowances, especially the HRA allowance, and give them these other things like leave travel allowance, which is eligible for some deduction for twice in a block of 4 years. And there are certain things which employer and employee must discuss at a early stage and plan, for which you should take a detailed advice, separate advice for this particular purpose. What all things are possible for one to take. See, for example, 2 years ago, till 2 years ago, the dividends paid by companies were not taxable in the individual's hands. They were taxed at the corporate's hands only as a dividend distribution tax. Now, those taxes are on employees. And if employee is on a 30% tax slab already, so you are literally paying 30% on the dividends that you have received. So many people do this analysis of, how about taking dividends? So if I get dividends, I have tax-free income, which is today, which is not relevant. So if these tax laws change every year, there are newer provisions that come in, and things keep changing to and fro. So it is better to take advice from a tax expert or a practicing chartered accountant in this matter. I wouldn't like to give tax advice in an open forum. I have only given you 1 or 2 examples. That all I can do, because I'm not supposed to give you a kind of a tax advice which is not complete in all respects.
Sure. I hope that answers the question. Sir, I'll go to our next question, and it is about the employees who join the organizations in between the financial year. So the question is, what are the details I need to capture from his or her IT statement for those employees who have joined during the middle of the financial year, like income from previous employer?
This must be a question from an employer or a HR. I do not know whether there is a consistent process of recruitments across all employers. Assuming an employer who takes details of his previous employment in his CV or in his interview, and even collects the salary slip of the previous employer, that is a reasonable proof for you to know that there has been a payment earlier. So based on that, you can ask the employee to give you the details of that particular past employment. One. Secondly, you can ask him to submit his Form 26AS in case he does not have Form 16, because Form 16s are normally issued after the end of the year. So you will not get it at that stage. So Form 26AS could be the only document that may be available, but that an employee or his tax advisor or tax filing professional can provide to you. But best is ask for that declaration from the employee in Form 12BB itself. And suppose he has not given that, and you as an employer have no other way to find it, despite all your efforts, you are not obligated on his behalf. You can blindly take that Form 12BB and consider only those particular details. If you have those salary slip or his actual payment details from Form 26AS or other like AIS and TIS, as I mentioned. So if you have those given to you by the employee, consider them. If you don't have, remember, there is a liability of paying interest and interest on the employee also as a taxpayer. Suppose his taxes have not been deducted, irrespective of whether you have done TDS or not. See, you can defend your TDS based on his Form 12BB. If he has not given you Form 12BB, you cannot go out of the way and find out his other details, right? But if he has not given you Form 12BB, and now let's say there is a tax liability pending as on 31st of March, and he has not paid separately an advance tax as well, then the applicable interest provisions under Section 234 B and C will be applicable in his case. And when he pays actual tax on a self-assessment basis at the time of filing returns, even this particular interest has to be paid by employee. Employer will be safe, as I mentioned, as long as you have taken care of his basic details available with you.
Sure. Thanks for answering that, sir. I hope the attendee has got their answer. So the next question is about the component which is not covered under Section 80C. So the question is, do I have to pay for the money while investing or while only selling it if it is not covered under 80C?
Can you please repeat the question? I may not have got that question correct.
Okay, so the question is, do I have to pay for the money while investing or while only selling it?
Pay for the money, I don't know what exactly. What I understand is he or she is referring to the investments done in those equity-linked schemes or those particular eligible items. It is actually the investment that matters for 80C, not the selling part. Selling part comes into effect under capital gains. The income from capital gains, which is not covered today by us in this session. That is a different issue altogether. But here it's the investment that you do in each of these areas, as I mentioned, LIC, NSC, PPF, and all that, including the equity ELSS schemes.
Sure. Thank you, sir. So I hope that clarifies the question for our attendee. Sir, one of our attendee would like to know the use of Form 12B.
12BB.
Yeah.
Yeah, I've covered it under the session earlier, but I'll just repeat for clarity.
Sure.
As I mentioned, 12BB is a courtesy form, I must say. It is not a mandatory form like, let's say, Form 16 to be given by employer to employee. Form 12BB is a benefit form for an employee to ensure that his employer is aware of the expenditure he is going to incur or the investments that he is going to make, which are eligible for deduction under the Income Tax Act. What happens if he doesn't give? The liability for him will be a higher tax deduction by the employer, right? The employer will deduct higher tax if you don't give that Form 12BB to the employer. So it's in a nutshell, it's simple. Form 12BB is your benefit. Use it. And even you don't give it, employer doesn't need to go out of the way. Employer can request maybe by an email, please submit your Form 12BB by this date. If you don't submit, employer has nothing to deduct from your income from salary. He can deduct tax on the entire salary income.
Sure. Thanks for answering that, sir. And also one of our attendee has a query related to Great HR. So the query is, what is the process of tax declaration, proof verification, approval and rejection in Great HR? And how can I view employee tax computation for any fiscal year in Great HR? So dear attendee, we'll do one thing. I'll drop the email before we end this session. So you can see the email ID on the screen. Please make a note of it, and you can always write back to us on that mail ID. And one of our concerned teams will definitely get in touch with you to give you more details on it. All right. So I hope this satisfies you for now. Moving on to our next question. Sir, this is about investment done in post office. So the question is the investment done in post office under personal savings is taxable if it exceeds 5 lakhs?
Post office investment, see, taxability does not come in the investment itself. Taxability or non-taxability is on the income that you earn on an investment or a deposit, right? Subject to the deductions that are available. Okay, so we were talking about investments under, let's say, Section 80C. If, post office savings bank, post office FD, whatever is eligible, subject to the other conditions, it is the deduction available under 80C. But investment per se itself is not taxable event. Taxability comes at a time when you earn income on that.
Sure. Thanks, sir. And dear attendees, I know we are running short of time, and many of your questions might not be answered, but please don't be disappointed. We will definitely get back to you with the answers for your questions. In the meantime, I'll just take up a couple of more sessions, sir, before we end the session. So the next question is about stamp duty. So the question is, one of our attendees says, I had paid the stamp duty last year, but didn't declare the same. I have declared the same stamp duty today. Can I get the benefits for the same? Secondly, are there any penalty or anything for missing out this information in my last declaration?
No, two parts in that question. One is stamp duty that related to last year. It should have been claimed last year because the 1.5 lakh limit that is given is for that particular year. You cannot carry forward a unused Section 80C benefit into the next year. Likewise, suppose you paid LIC premium of 2 lakhs, you cannot say, I have submitted for 1.5 lakh last year and 50,000 I want to carry forward for this year. That is not possible. That is part one of that question. And secondly, penalty, there is no penalty. This is your penalty is that if you were eligible and you're not claimed it, that itself is a penalty. There is no other penalty for you for not declaring that. I just want to clarify for other people, what is the stamp duty? Stamp duty is like when you buy a new house where you pay an amount. Let's say even your housing loan repayment has not started, but let's say in March month you bought a new house. In that month, if the house is let's say of 50 lakhs and stamp duty is around approximately, let's say 6%. On 50 lakhs, 6% is 3 lakhs. Okay, but the entire 3 lakh may not be available for you. Supposing you have no other 80C benefits, you can claim up to 1.5 lakhs for that particular financial year, and you cannot carry forward the remaining into the next year. If you have not claimed also, you cannot claim it in the subsequent year. And as I said, no penalties.
Sure. So I'll go to the next question, sir. It is about fixed deposit. So can you please explain fixed deposit in terms of tax?
Fixed deposits, they are eligible under 80C if it is more than 5 years, that particular scheme with the bank approved by RBI. If you have invested in that FD for a period of 5 years plus, there was a specific scheme which is eligible. I'm assuming that FD scheme is still applicable in this financial year also, but it was applicable till the last financial year. Along with the other deductions under Section 80C.
Sure. So the next question, so I'll just take last two questions, sir. This is, I think, from one of the employers. So the question is, please explain employer formalities to consider if an employee joins in the middle of the financial year. Also, please explain, is it mandatory to provide previous employment details in Part B of Form 16?
Okay. Previous employment details, whether it is mandatory and also what process to follow, each employer will have their own process, and for Income Tax Act, there is no specific procedure that has been specified as to what you should do if somebody joins you from the previous employer. At the most, what you can do, you can ask for his previous employment details. What if, as I answered a question earlier, what if he does not give the details, or he says he was not employed, and there is no way for you to collect? Suppose employer is in a desperate need to employ this person, and he forgoes even to verify a salary slip of the. Not every employer verifies a salary slip when they recruit. There are all the big employers, they have the standard protocols, standard procedures, but it is not so in many of the small entities who employ 10 people, 15 people, or less than 20 people. They may not have that kind of details. Larger, you also have kind of, let's say, PF. Wherever there are more than 20 employees in an organization, there is a mandatory requirement to register under PF, right? Provident Fund. So there you get all the details of a particular employee, where he transfers his account of PF into your records. Those are the details you can obtain. But beyond that, I don't think an employer can go much beyond to collect the details. You can do only a reasonable amount of effort collecting, maybe even salary slips. Employees don't like to share the salary slip. Then you have to see, as an employer, are you in a desperate need for hiring that employee? You may forego that requirement. It has happened before also. I think you need to tell me, as an employer, what safeguards you guys are taking, because I have seen all different types of employers. So I cannot give you a standard single answer for that. Maybe they can enlighten me. As I said, I'm a continuing student of all these things as well. What is a practice that is happening in other parts? Maybe you can share that information on my email or whatever, if you are not able to speak out on this session.
Sure. One last question for today, sir. The question is, can we produce medical bills of parents on or above 50,000 standard deduction?
No, because the standard deduction that was given was earlier a couple of different allowances, like traveling allowance used to be given in the past. All of that were combined into a standard deduction, and 50,000 was given. So parents' part, especially the medical bills, are not covered under the salary part. But there is a section 80D where you pay a medical insurance under which these amounts may be eligible. That is one part. Secondly, if an employer provides medical facilities to his employees, along with other things, for example, entertainment, education, training, etc., to their employees, they are considered as perquisites which are exempt from tax to a reasonable level, as long as those facilities are provided across the board, not to some specific employees. But no, my answer is for parents, medical bills, etc., reimbursed by employer, they are not eligible for exemption. No, and also you cannot claim any other deduction other than 50,000 standard deduction as a medical expense.
Sure, sir. Thank you so much for sharing all the information and answering the questions. Sir, if you allow me to just share my screen.
Yeah, I will stop this.
Yeah, thank you so much.
Okay.
So dear attendees, I think with this, we are coming to end of this session, and I know I have not answered or taken a few questions here, but like I said, please don't be disappointed. Due to interest of time, we could not touch upon all the questions, but definitely you can always write back to us on the mail ID, or you can even join our Great Ride community. So to tell you more about Great Ride, it is basically the Q&A Q&A forum where a lot of knowledge sharing happens about the HR and payroll industry. Okay, so many experts like Agnel sir and several other industry experts are already part of this expert panel at Great Tribe. So you can always post your questions on the Great Tribe and have your questions answered. So the link to that is already given below here. And the being part of this community is completely free of cost. So please don't hesitate, sign up for the community and be a part of it by gaining and sharing the knowledge. So on this note, I think we are now reaching to end of this session. So once again, I'd like to thank Mr. Agnel for the wonderful session. You have certainly given us a lot of great insights on tax declaration and filing, sir. And also thank you to all the attendees who joined us today and made this session successful. So if you have any more questions, you can see the mail ID, rakigautam@creative.com. You can always write back to us on this mail ID and we will definitely get back to you with the answers. So we will see you in the next session with another interesting topic. Till then, stay safe and have a great time. Thank you so much.
Thank you very much, great HR team, and also all the audience for their patience.